Order, order. Welcome to the Treasury Select Committee on Wednesday, the 20th of May 2026. Today we've got one of our regular sessions with the Bank of England, particularly relating, of course, to the Monetary Policy Committee's last decision, which was on the 26th of April, where the decision overall was to hold interest rates at 3.75. And so I wanted to welcome our witnesses. We have, of course, Andrew Bailey, the Governor of the Bank of England, joined by Sarah Breeden, the Deputy Governor, whose particular focus is on financial stability at the Bank of England, Dr. Swati Dhingra, who's one of the external members of the Monetary Policy Committee, and Dr. Mann, also an external member of the Monetary Policy Committee. So very warm welcome to you all. I think probably it's pretty clear about the decisions for hold, and thank you for your your thoughts on that you've provided us, or you provided the nation on that. But obviously the big issue in town is what's happening in Iran and the Middle East, and I really just wanted to get a quick sense from each of you about whether that really was the main reason that you made hold, and what your concerns are about the long-lasting impact of the situation in the Middle East on inflation. Perhaps I'll start with you, Governor.
Yes, well, I was looking back actually, because I'd sort of forgotten that the last time we were here was 4 days before it began, and none of us, I think, at that hearing certainly had any idea what was going to happen. So it really has, of course, been the dominating change in the landscape since then. And it's interesting, you may have seen, obviously we had an inflation number out this morning, and I remember back to the hearing we had then when I was saying, well, I thought it was today that we would actually be back around target, and I think actually everything we've seen since, including today's number, actually sort of justifies that judgment. Unfortunately, obviously we've had events since then which have changed the picture. We're also in a world which, of course, is very unpredictable and uncertain in that sense. And the way I look at it is that there are sort of three starting things that really sort of condition our judgment on this. One is, how long is it going to go on for? Two, whenever it does stop, what is the lasting damage that's been done to the energy supply infrastructure, and how long is it going to take to put it back in place? And then the third, and by the way, neither of those two are things obviously we can influence, but they have an impact on the third one, which is the one that obviously we can, which is what are going to be what we tend to call the second round effects of all of this in terms of the inflation picture. And that depends on a number of things. It depends on, obviously, on those two things, on the impact. It also depends upon, as I'm sure we'll come on to, the sort of the condition of the economy and the context in which we're operating. And that's really certainly for myself, that's the framework of judgment that we're operating in. Now, what I would say is this, that I think, the judgment you reach and the judgment we reached back at the end of April, obviously where you get to depends on where you start, as it were. As I've said certainly at the last hearing, and may have said at a previous one as well, it was certainly it was a reasonable expectation prior to this all happening that we would probably cut once or twice this year, and the market was pricing that. Now, the market isn't pricing that now. I think effectively that was taken off the table, and it was really taken off the table, I think, with the March decision, quite reasonably. So if you start there, then effectively we've tightened policy because we've removed the expectation of a cut before you start talking about what might happen next. And you can see that, by the way, obviously in the way the curve has moved. You can see it in mortgage rates. I mean, the increase in mortgage rates, for instance. Now, therefore, that tightening, I think, also gives us, I think, some time to assess. And so the whole decision for me is also reflective of that point. Very high uncertainty, very high unpredictability. But I think the fact that we start in this position, we start in a position where, as no doubt we'll come on to, I think we've got a somewhat softening picture for growth. We've got a somewhat softening picture for the labour market, none of which is really inconsistent with what we were talking about last time we were here, actually, is the context. So I think a whole decision was appropriate at this point.
Okay, Dr. Mann, I mean, you had some interesting things to say in the minutes about your position being an active hold position. What do you mean by that, and what are your thoughts on why? Can you just expand a bit on why you voted to hold and the impact on the Iran war?
So my strategy for monetary policy decision making all along has been activist. Now, activist can either mean moving in 50 basis point or more increments which I have done both up and down at various times over the last 5 years. But it also means you can hold for longer. And that is also something that I have done, even as there have been other parts of the members of the committee that have moved in a 25 basis point increment. So what am I looking for now, and what are my concerns? With respect to the issues on labor market slack and pricing power, going into prior to the Middle East conflict developing, I had thought, well, I will be close to a position where labor market slack might in fact be sufficiently in evidence as to reduce demand for goods and services. So that would limit the pricing power of firms, and that was where I was last time with a hold, or 2 times ago. Last time, the last most recent meeting, where do I sit that's slightly different? The first point is that on firms' pricing strategies, in the face of a common shock, which this energy price has been a common shock, firms do tend to pass it through to a greater degree on the upside and not so much on the downside. So there's both a pass-through as well as an asymmetry with regards to ups and downs. And I thought that was important to consider possible moves going forward. The second issue, though, is importantly on what the dynamics for inflation look like in the second half of this year. Why is that particularly important? In the past, I have not been as concerned, or at least in the last 2 years, not as concerned about the labor market. Yes, it was softening. Yes, wages were coming down. We're becoming more closer to what we would consider target consistent. However, if it is also the case that inflation expectations play a very important role in wage setting, and wage setting is going there's a seasonality in wage setting. We kind of had some in April, and that was relatively soft because, of course, inflation had been coming down at that time. But when I look into 2027 and the possibility that the wage bargaining in the first quarter of 2027 is going to be on the back of a relatively high inflation prospects for the second half of this year, that is something that makes me worry about an embedding of both the cost structure for firms and their price setting, as well as inflation expectations and inflation outturns in the second half of the year becoming embedded in wage developments for next year. And so that puts me in the position of looking at those 2 elements going forward, particularly of a concern. Against that, however, I have to acknowledge that financial conditions have tightened dramatically. And that plays an important role in the transmission of a hold or whatever the committee decides to do. It's against this landscape of the broad set of financial conditions, and we have to take that into account, or I have to take that into account in making my decisions going forward.
Thank you. That's very helpful. Dr. Dhingra.
I can explain my decision, particularly with respect to how I was voting in February. I think had we been in that position that the Middle East crisis had not happened, I would have felt fairly secure in terms of the way the nominal dynamics were going, in terms of the weakness in the real economy, which meant we weren't going to see another flare-up in any sort of near term. And also compared to, say, some of the peer European countries, which look very similar in terms of wage inflation or services inflation, we didn't see that kind of, despite much lower rates there, we weren't seeing any kind of derailing of a disinflation that we were seeing here. I think, of course, all of that now has to be completely revised, because I would say probably some of my worst case scenarios have unfolded or are looking like they might unfold. And unfortunately, I don't know how to put probabilities on these events, whether we will be in a scenario A according to the MPR or whether we'll be in a scenario C. I think one thing is pretty clear, which is there is a lot of tightening already in the system at 3.75. We're clearly, even by the most generous estimates, which I don't find necessarily particularly credible, that we're really restrictive at this point, and the economy looks weak enough that it doesn't look like we're going to see some kind of consumption-led boom at the moment. So I think given all of that setting, it looks like there is enough in the system out there that even if we see somewhat of a scenario B unfolding, we should be able to control inflation. I'm more worried about the fact that now we are faced with a much sharper policy trade-off, that when inflation happens now, and if we do need to tighten in a more severe scenario, then we are going to have to pay a much higher cost for that. And for the obvious reason, the economy is in a weaker place. Monetary policy is already tighter than when, you remember the 2022 shock. So in that sense, there is more sort of uncertainty about which way things would unfold. And I think broadly speaking, I would say that, even in a fairly severe scenario, we have enough tightness in the system and the economy is in a position where it's normalized compared to where it was in the pandemic, that we shouldn't see the disinflation process derailed and things would normalize in due course. But I can't rule out the possibility that these are twin energy shocks happening at the back of each other, which can then have repercussions for where inflation goes, and that's why we've got to do our job more strictly than before.
Okay, and finally, Sarah Breeden.
Thank you. Like Swati, I found it helpful when thinking about what to do after this shock to have in mind the world that I expected to be in prior to it. At the February monetary policy report, I expected inflation to come down to 2%, and with wage growth already target consistent and with little signs of pricing power in a weak demand environment, I expected inflation to stay there. So with that context and bank rate already restricted, I would have expected to vote for 1 or 2 more cuts this year. In this environment, which is, of course, as Swati and others have said, completely different, we have seen already a tightening in financial conditions. The yield curve is 60 basis points higher now, was in April higher than in February. It's 80 basis points tighter now. And as I say, that was from an already restrictive policy position. So in a world where we are trying to offset second round effects, I think, like Swati just described, we have had sufficient tightening in the conditions that matter for businesses and households to be able to offset those the current risk of second round effects. We do have to be alive to the risk of a bigger shock and that having a bigger impact on second round effects. But I think we're well placed at the moment to be able to judge how that plays out rather than needing to move quickly to do so. But if it does look like we're moving to a prolonged conflict with more meaningful second round effects, obviously we will have to be ready to move swiftly and if necessarily forcefully.
Before I hand over to Mr. Yang, I mean, Mr. Governor, you talked about the second point being what is the lasting damage to energy supply infrastructure. Where do you get intelligence about that from? Obviously, at that last meeting, probably too soon to get it, but given that is as you rightly highlight, a very real concern, do you get intelligence on that, and does that feed into your...
Yes, it does, yes. So we talk to, I mean, we get it from a number of places, so we talk to people in the industry who are obviously much more expert than we are. I talk a lot to my counterparts in the Gulf countries. I see a lot of them, saw them yesterday actually, in Saudi Arabia, UAE, Qatar, and they're obviously on the ground. They know exactly what's happened. I think the assessment is that there's been more physical damage to the gas supply infrastructure than the oil supply infrastructure. Oil would take some time because, as we always hear on the news, I mean, there are ships in the wrong place. The whole supply lines have been disturbed. The Saudis have actually been quite effective. They can't, I mean, this can't do everything, but they've been quite effective. They have this one pipeline that goes across Saudi Arabia to the Red Sea. They're using that to its full capacity at the moment, I think. It doesn't replace all the lost supply by any means, but I think in the case of gas, and this was particularly the attack on the gas field in Qatar, it has damaged some quite key pieces of the infrastructure, which are quite apparently technologically complicated and will take some time to replace.
Okay, so when you come to Sarah Breeden, when you come to your next meeting, you'll be considering all this.
Yes. I was just going to say that intelligence really fed into the design of our scenarios. So scenario A
Already
is the
used
one
it,
that
yeah.
we usually use based on what the future financial markets are telling us. But given all of that intelligence that we'd got from the range of contexts that the governor described, we did think it was prudent to put in a different scenario.
I would just add 2 points. The first thing to say is, I mean, you know, and this is reflected in scenarios. I mean, I do think that the futures curves are pretty benign when you sit them alongside what I was just saying about, particularly in the gas market, on the damage to the infrastructure, which again was why in the scenarios we have one scenario that follows it, but then we have scenarios that aim off that. And I think that's important. On the other hand, I think the important thing is, this is important in judging it compared to 4 years ago, this is much more of an oil shock than a gas shock globally. So there's damage to the gas field. It's a smaller part of the overall global picture. And that's relevant. It's relevant when you look at, for instance, the relative movements in the off-gem cap. They are much smaller than 4 years ago. And the reason for that is that far more of it's in oil than gas, and gas is a bigger part of the UK story.
Okay, thank you. That's very helpful. Yuan Yang, MP.
Thank you. I have a question about your responses to potential new data and also new measures. In our last session, we talked about how the government's intervention on, say, energy bills in terms of fiscal policy had brought down headline CPI. Given that all three scenarios that you've projected have quite a significant output gap, do you think that there is more policy space for such measures that bring down CPI to have a positive impact in terms of your mandate on curbing inflation? Or do you think that they would have bad effects in terms of stimulating too much demand?
Obviously it's for the government to take those decisions, not for us. We have our tools to, in a sense, to do monetary policy and to tackle inflation, and we don't sort of consider things that could be done outside our framework. I think that's important. I mean, the other thing I would say, and I don't want to in any sense sort of therefore decry government looking at them, not, but I do think, some of the very big measures that were taken in the past. Now, admittedly, as I've just said, it was a very different situation in terms of the scale of the issue. But very big fiscal policy measures, of course, let's be honest, I mean, they are putting off the issue. I mean, the cost comes back to you later. So I think government is right to sort of think about these measures, but they're right to think about them also in that context, because eventually this cost does come back.
Purely in terms of the macro impact, and there may be fiscal and other measures. We'll talk about food a bit later in this session. And what do you see as the macroeconomic impact of that reduction in CPI in terms of how it affects the output gap and inflation?
Well, obviously, I mean, I think Catherine was referring to this earlier. Inflation expectations are an important part of this story. And we obviously have seen, if you go down the rank order, because you have household expectations, business expectations, and financial market expectations, and they've moved pretty much in that order. So the biggest move has been household, followed by business, followed by the lowest has been financial markets. So they are influenced, obviously, by these things. As I think Swati was saying earlier, you were saying, this is the second energy shock in 4 years. That will weigh on households' thinking, no question about that. So look, I mean, measures. I think there was something announced at Prime Minister's questions, a couple of hours ago, I think, on the delay in fuel duty. I mean, they're obviously relevant, and we will consider them. We obviously factor them in now they're announced, and they may be relevant to that inflation expectations formation process, for instance.
Is there anything anyone else wants to?
So from a macroeconomic view, I mean, we have quite a bit of information in the household cost index of exactly how different deciles in the economy, how their baskets, how the prices of the different components of their baskets change. And at the time when the last shock hit, we were able to evaluate the extent to which the different programs that were put into place at that time would affect different income deciles, and also use that to evaluate the extent to which a change in the overall CPI, which of course was a very important feature of the energy price guarantee. Instead of 14% inflation, it was 11%. So we could track how those these different programs would percolate through the income deciles. We can do the same type of exercise this time with a little bit more granularity once it becomes clearer what the programs might look like. And so we would be able to take that into account when making our judgments
And some of that modelling published as well.
Back in the day?
Yeah.
Yeah, it was in the NPR.
Right.
Yeah.
If I could just illustrate this point on energy, I think the current Ofgem cap is £1,641. The latest market estimate for the next quarter is 1,850. Had there not been government intervention, I think the estimates of what it would have been at the beginning of 2023 is £4,279. So that gives you a sense of the sort of comparison.
If I can add a couple of really quick points to that. So just to broaden the question out a bit. So one was we already saw what happened with the interventions that the government did with the monthly inflation number that's come in today, which is that many of these administered prices have taken some of the pressure off of the headline inflation. And also, if you look at the past energy shock, one of the key reasons we saw this really sharp drop that happened after the really big energy price spike that happened very quickly is because a lot more supply came on the market, which in this case was largely driven by the US coming into the LNG market. But more broadly, supply side policies are particularly useful in being able to alleviate inflation pressures without putting excess pressure on output.
Thank you.
Thank you very much. Chris Coughlin, MP.
Thanks, Chair. Gunnar, you're talking about inflation expectations, and do you get any comfort from the fact the NPR report indicates that household and firms inflation expectations have risen in the short run, but only slightly in the long run, and therefore perhaps they're not de-anchored, and therefore rates may return to target in the medium term?
Well, it's an important distinction, you're right to point to it, and the way we interpret it is that short-run inflation expectations are heavily influenced by what inflation is today. So if you ask people what they think inflation is going to be in a year's time, that is quite heavily influenced by what they believe inflation to be today. Now, as you go further out, that's not the case, hence the distinction. And we look at the further out very carefully because you would expect it to be anchored more to the inflation target. Not precisely necessarily, but anchored more to it. And yes, you do see that, but we do watch this very carefully.
So you are confident that expectations are not de-anchored?
No, I don't think they're de-anchored at the moment, but I can tell you we do. It is something, and I think Catherine was describing it very, very well earlier. We do watch very carefully because, I think there is a tension in here. I think, which is, as I said earlier, we're seeing softening conditions in the real economy, but we have, because of this energy shock, seen an upturn. Quite an upturn, particularly as you said, in short-run inflation expectations. So that's a point of tension. I mean, which of the, in terms of this point about second-round effects that I made. Which of those two things is going to have more weight in that?
Yeah. But I mean, the NPR report does note that firms are more likely to raise prices in response to inflation. So, I mean, could this initiate a wage price spiral? Are you worried about this?
Well, I don't think wages, of course, are the other part of this. Now, we've seen, I think, a continuation, as with the numbers that came out on Tuesday. Yesterday, we've seen a continued gradual reduction in the increase, particularly in private sector wage settlements. I would also say that we have another way into that, which is, again, survey evidence on wage increases. Our own agents always do one at the beginning of the year. They did one at the beginning of the year, but that was before any of this started. But we do get the decision makers panel survey. That is actually more benign, I would say, so far. But we're going to have to watch that one very carefully as to what it's showing. The other thing Catherine mentioned is there is a seasonality to wage increases, as you were saying, Catherine. It means that a lot of the private sector wage settlements have been done this year, so we will get information, but it will be a while before we get information, a lot of information on that front.
And Dr. Mann, how sensitive are we seeing wage growth to unemployment, and could stagflation become a reality?
So on your previous question about pricing and so forth, and its relationship to expectations. One of the things that is an important ingredient in the relationship between wages and prices, and particularly in expectations, is what our research has identified as threshold effects. So consumers pay a lot more attention to food and energy, we know that, but it's also when inflation as an aggregate gets above, say, 3.5%, 2.5%, then there's quite a bit more of attention in general to the inflation process, and it starts to look like it gets embedded in price setting by firms, because firms increasingly set their prices based on the state of the economy, and inflation is one measure of the state of the economy. And of course, wages tend to get settled as well on the state of the economy, including the expectations. Again, I'm concerned on the private sector side for wage setting in the first quarter of next year, which is the seasonality for most of the private sector wage setting. And some of the research that shows up in the boxes in NPR noted the extent to which certain characteristics of sort of different groups key off of either inflation itself or bargain against expectations. Is about 80% do. So it's very important for me to be looking at the second half of the year. And the way I can do that, you sort of say, well, how do you look at the second half of the year? It hasn't happened yet. Again, our decision maker panel has 1 year ahead price expectations, 1 year ahead wage prospects, and we can track the extent to which firms are pretty good at estimating their future price and wage outturns. And they have been pretty good at that, and so that to me is forward-looking information on which I can make some assessments. Now, with regard to wage settlements and different groups in the labor market, we have to look very carefully below aggregates. Most of the softening in the labor market that we've seen so far is in a couple of categories, particularly hospitality, retail, and in information technology. They account for most of the numbers of unemployed. So to me, that means that the labor market softening, while true, is not broad-based. In my view, that's not broad-based. And when we think about different groups, the hospitality and retail have less wage flexibility on the downside because of the approaches to minimum wage. And that just means that to the extent that there's adjustment, it's going to be in some other margin than wages. It could be profit margins, it could be numbers of people. And of course, there could be capital labor substitution and productivity enhancements as well. Right. But it does mean that when we think about the relationship between the labor market and the wages, we really have to get into a much more disaggregated analysis.
And specifically on not being broad-based, I mean, think about hospitality and IT. With hospitality, one could argue perhaps that a lot of that's been driven by tax increases, national in a low-margin industry, and perhaps if IT change shifts to AI, could be driving sector, relative sector. Would you agree that's?
Yeah, that is consistent with my assessment of the labor market. Yes.
Thank you. Andrew Bailey, the Roger Bootle, the Vice Capital Economics, notes that the previous inflation in 2022 was accompanied by a sharp rise in broad money supply, but we're not seeing that this time around. Do you take any comfort from the slow growth in money supply?
Well, I mean, we look at it. I look at it regularly, and you're right that if you were basing your decisions on money and the money supply, you would not see inflationary pressures. I think it's always sensible, though, to look at it in the round with other things. So it's one of the things that influences. And also it's important to look at the stories that lie behind that. But at the moment, no, it's not flagging pressure in that sense, no.
Thank you very much, Mr. Coughlin. Jim Dixon.
Thank you, Jane. Meg. Just turning to some of the household finance issues that are likely to be a real concern to our constituents, that we're already hearing about some of those worries. Perhaps to Mr. Bailey first, how do you think food and other prices, which are obviously very important to household finances, are likely to be impacted compared, for instance, to the 2022 fuel price hike?
So, I think it will happen. Today's number actually had a quite surprisingly actually benign food price inflation number. It came down actually, which was a little bit contrary to what we were expecting. I mean, the way I look at it, there is a sort of a sequence of effects in terms of the feed-through of an energy price shock. So the first one, which we've already seen, obviously, is the one that comes through particularly at the pump, as it were. So pump prices adjust very quickly, for instance. The second one in the UK is where the UK is a bit different, and this is why, by the way, I mean, today's number looks quite benign, but we have to take this into account because this pushes in the opposite direction. That the way in which the Ofgem mechanism works means that there is, because it's a quarterly reset, there is a delayed reaction, if you like. I mean, it is going to go up. The inflation number that we had this morning reflected the fact the Ofgem cap came down in April. Well, now we know it's going to go up in July. In fact, we pretty much now know how much it's going to go up because it's through the observation period. So that's the second one. Third one, and this is where we get food, is what we tend to call the indirect effect. Now, that's, in other words, where energy is a component, obviously, and a contributor to the costs of other products. And honestly, I mean, I think one of the things I learned, certainly 4 years ago, was just how large an energy share there is in things like processed food production and distribution as well, but including that. So some of it, we're getting up to numbers like 30% of the cost is energy. So obviously, therefore, energy prices do come through. Now, how they come through and when they come through depends upon the business energy supply costs that the producers of food, for instance, are experiencing. We go around the country a lot. We talk to a lot of companies. So a lot of companies obviously take out energy contracts. They therefore hedge to a degree. It depends what the nature of the contract is, and it also depends when they reset the contract. I mean, when I always ask companies, I can tell they're either going to sort of slightly smile at me because they've managed to reset their contract just before the increase happened, or they're going to look extremely pained because they're about to reset their price. And you don't know until you talk to businesses which situation they're in, but it will come through. I think it's really too early to sort of start. I mean, I see a lot of speculation about what food inflation is going to be later this year. I think it's very hard at this stage to really put any good figures on that at the moment.
Perhaps, Dr. Dhingra, there was some suggestion from the bank's agents mentioned in the NPR report that we could be looking at food price inflation later in the year of 6 to 7%. Would that be a figure you'd be expecting might come through?
I think the important thing to keep in mind here is that it's much less. It's an order of magnitude almost smaller than the food inflation we saw in the past. So I think that's really important. What precisely the number would look like is really hard to tell. Even if you were to trace what's happening to, say, global food prices from where we're going to import things, those are moving in all sorts of directions. So it's really not, I wouldn't want to hazard a guess on that one. I think what the governor outlined about the sequencing of how these effects work, I think that's something that we should expect to happen in the future. And we're very alert to that point that, yes, there will be food price inflation, and we're going to have to think about that.
Thank you. And perhaps for Mr. Bailey again, just has there been any contact from the Treasury to discuss with you, either for information or on any other basis, any steps that the Treasury might be looking to do to intervene around food price inflation?
No, I've seen the stories, particularly earlier today, on this. We've had no contact with the Treasury on that, so I'm afraid that's a question you'd have to ask the Treasury.
Would any of the panel wish to comment on whether there are any interventions that the Treasury might undertake, particularly around food pricing, that might help to reduce the future level of inflation going forward at all?
I'm looking at Dr. Mann because she's
I'm
the employee of the bank.
I'm not going to comment on any of the interventions, but I will comment on, if we compare, you go into your grocery store today versus 4 years ago, you go into the grocery store today and there's the little label matching Aldi or matching Lidl. And 4 years ago, you did not see that type of competition undertaken in the grocery stores. You did see empty shelves, but you didn't see competition where there was, if you want to do comparison shopping, it's right there. You can do it.
I mean, the big difference, by the way, going back to Swati's point, was that 4 years ago, was that, of course, Ukraine is a major global food supplier, and that's a big difference. We're talking about an energy shock here. 4 years ago, we had the Ukraine war as well.
That's helpful. If I could just ask a question about our exposure to the jet fuel market. All the indicators show that the UK is a particularly large importer of jet fuel. Do you think this is likely to have an effect on a significant effect on inflation in the UK as compared to other territories?
Well, it obviously affects transport prices, it affects airline prices. That is one of the more volatile components of the services indicator, index, I apologise. I don't in any sense pretend to be an expert on this market, but again, going back to, I think, the Chair's question earlier, we do talk to a lot of people about the energy markets. I think you're right that in the sort of rank order of things that we're experiencing scarcity, jet fuel actually was sort of probably at the top. But what I've picked up more recently is that I think first of all, there's been a switching to alternative locations of supply of jet fuel, because jet fuel comes from other parts of the world. Secondly, I think that there has been some switch in refining activity to actually refine, to produce more jet fuel. So I think, so I'm not the expert, so I don't want to give false comfort here, but my sense is that there are measures being taken globally which are easing that position.
One final question, Dave, Meg, if I may. Just in terms of the length of time for which we're likely to be experiencing the shock that comes from the closure of the Strait of Hormuz, if that, if the closure ended reasonably soon, how long are you, as the MPC, thinking that the effects from that closure are likely to last going forward?
So that's going back to my sort of three parts to the story point. That's the second part. What we're told is this. I think in oil, it would be a matter of a number of months. And that's a lot of that is to do with getting the sort of the supply chain back into order, as it were, getting the boats in the right place and so on. With gas, I think it's actually it's quite a bit longer than that. It could be a year or two or more, because of this need to rebuild the infrastructure. But then, as Swati, I think you were saying, Swati, earlier, there has been more gas supply, LNG, or perhaps I can't remember saying it anyway, come onto the market since the shock 4 years ago. And by the way, I should say about oil, I mean, we were in a position before any of this started where there was, if anything, a surplus of supply in the oil market. So if we get back to that point, it's a question of how long it takes, to your question, to get back to that point.
Thank you very much, Mr. Dixon. Yuan Yang, MP.
Thank you, Chair. I just want to press a bit more on my colleague's line of questioning earlier about the Treasury's measures. And I was wondering if it would be normal for when the Treasury is looking at interventions that change prices, so lowering the cost of living, for them to have that conversation with you to understand your reaction function to different measures, or is that not part of the institution?
Well, normal in the sense that we often, I mean, obviously, if it's part of a budget, then there is a sort of process for having those conversations, and they would keep us informed. I didn't know that the Prime Minister was going to say what he said in Prime Minister's question today, but that's all right. I don't need to know. We now know, and we'll take it into consideration.
Understood.
Anyone else want to comment?
I think just long term, if you were to think about what that coordination should look like in a world of big supply shocks, I think that's something for Parliament to think about.
Taken the hint.
Yeah. Mr. Grady,
I just ask
last try.
one question, and this may be a daft question, but when I read people like Professor Nick Butler, formerly of BT, and Professor Beryl of the International Energy Agency, commentating in the FT, they suggest that actually reserves are becoming very tight. That actually we're sailing into one of the biggest energy crises we've ever seen, even bigger than Chancellor Healey and your predecessor dealt with in the mid-70s. And yet, the general discussion here is around 6% inflation. Is there a risk that we're missing the risk of a very significant shock that goes way beyond what you're describing, Governor?
Well, let me be honest, the longer this goes on, the more difficult it gets. There's no question about that. Now, I was at the G7 on Monday and Tuesday with the Chancellor, and the head of the IEA, the International Energy Agency, was there. He talked us through his latest thinking. And I think he's made the points a number of times that there are obviously drawdowns on the world's reserve supply going on. So the system is, in sense, in deficit at the moment, and that deficit is being made up by drawing down the world's reserves. I think the point he's made is that it would be I think, easy to think, if you're not a sort of technician in that market. I don't think you can fully draw down the world's oil reserves. I don't think they're all available in that sense, because there are various technical reasons why you can't do it. So I think sensibly, he's a real expert on this. I mean, he sensibly introduces a note of caution on this front when he talks about it, certainly.
Thank you very much, Mr. Grady. Dame Harriet Baldwin MP.
Thank you, Chair. Governor, you're a noted economic historian, so can you think of any
examples?
Noted, I think.
We have many economic historians who would dispute that, I'm sure, but anyway,
I have noted it. I just wondered if you could point to any historic examples where the state setting the price of food has been an effective economic intervention.
Well, I'm sure there are many in some countries. I think the question you have to think through in this sort of thing is, are you doing it for some, very sort of well-grounded, very, very temporary reason? I think if you start doing it as a matter of course, then you effectively, you're sort of artificially, moving prices relative to costs, and that's not a sustainable thing in the long run. But there may be reasons for doing the short run, I'd say, but it does need to be thought through in that sense.
I just perhaps put the same point to Dr. Dhingra, because you've often talked about this in your evidence to us, the global chain. How practical is it really possible in the modern world for one government to effectively put price caps or encourage price caps or whatever mechanism they use when it's not all in the control, the food supply chain is not in the control of one sovereign nation?
I often get asked this question. I don't have the solutions. I only have a sense of what would be economically logical, which is that thinking about where to find these sources of supply when you have a crisis is really key. And that's kind of one thing which we can think about doing. A lot of our food is imported, which many other countries don't face that problem. On the specific point about price controls, lots of countries have tried it, not necessarily successfully. And the biggest problem with these sorts of controls is you're dampening the price signal, precisely what you want people to react to. So as a market economy, you can do that for a little bit, but how long can you let it go on? I grew up with price controls on food all my life. And that story, to some degree was very successful in being able to cure famine and poverty and various things like that. But at the same time, what it's ended up creating is a highly distorted agricultural sector in India. So in that sense, do it with a lot of caution and a lot of thinking behind what it's trying to target.
I mean, there is, of course, another area which we're seeing at the moment where I think it's more justified and is being used, which is energy, where you've got obviously other sources of energy where the cost hasn't changed, but energy prices have. And I think governments do see that as somewhere where they do take measures, but that's a different situation because the costs haven't changed.
Dr. Mann, did you want to come in on this? Oh, I thought that's what you were indicating.
I thought Dr. Mann made an interesting point just now about the competitive nature of the supermarket sector in the UK. But if I could change the subject completely to another area where the government has intervened and changed the price of something, which is the price of employing a young person. And that's gone up by about £4,000 a year. And you've seen a huge increase to levels we haven't seen since 2009 in terms of young people who are out of work. And I wondered, Dr. Mann, if you could share with us how the monetary policy is looking at the labour market statistics at the moment, because it's been a problem area. There's been difficulty looking at those statistics. You've not been getting very accurate information from the normal sources. And I just wondered if you could share with us how you're thinking about how impacts like that, because there's clearly been a loosening of the labour market. There are fewer people on payrolls than there were a couple of years ago, whether that's something that you're factoring into your decision making and how.
We've been, as you can see from the boxes in the NPR, there's quite a bit of research that's being done by the staff using the granular data across different sectors, with the wages associated with those sectors, the beverage curve, and the clustered wage analysis. I won't ask you for whether or not you've read all the boxes and all this detail.
All your forecasts do show unemployment going up, don't they? Including the central forecast.
I mean, I think I've said before that when I evaluate the state of the economy, I tend to focus on the granular information that I can get from firms and with regard to their pricing strategy, their labor employment strategy, their production prospects, what they believe about demand, and I use that information to judge the state of the economy far more than I use the aggregate data, and it's the aggregate data that go into the forecast. So although that is the forecast that has come out, I tend to look at other information that I think is a better indicator of prospects for the economy. And for example, one thing that I think is a very important distinction for understanding the behavior of the economy, because it has direct impact on employment prospects, is the difference between GDP and market sector output. There's been a widening gap between these two different measures of economic activity. It also shows up in terms of employment in the public sector versus employment in the private sector. Last year, when there was quite a bit of a deterioration in employment in the private sector, employment in the public sector basically countered that almost entirely. Things have been different towards the end of last year and going into the quarters here. But that type of analysis is to me indicative of what the prospects for the economy are. I might add for wages, for example, private sector wages at 3.2, 3.5 through DMP, through the agents, through the various measures of private sector wages, public sector wages at 5.2. The new national minimum wage for 21 and above at 4.1. These types of assessments, I find bringing them to bear to my judgment is the way I evaluate the state of the economy.
Thank you. And Sarah Breeden, you were nodding along when I was mentioning about some of the problems with the labour market statistics. Are you comfortable now that you're getting the right kind of information when you're making these decisions about the state of the labour market? And how do you see the softness of the labour market affecting the pass-through of inflation into second-order effects?
I very much agree with Dr. Mann's comments about needing to get below the aggregate data and understand what's happening in different industries and in different bits of the age distribution and skills distribution. I personally find it incredibly helpful to go out and talk to businesses about what they are actually doing with their hiring intentions. And what's really come through when talking to them is that as people leave, they're not replacing them. Now, that means their productivity levels are going up. That's a good news story, but it is a problem for entry-level jobs or for people coming into the labour market, which I think is the counterpart to your point about youth unemployment. So we take that into account when we're thinking about what's happening in the economy as a whole. It's not obvious that monetary policy is the only response, or indeed the right response to that, but it is a part of our decisions.
Indeed, and Governor, we heard from the chief economist last time about how he empathised with young people because it was something that he was seeing in his own family. And I just wondered what assessment you've made now of the impact that artificial intelligence might be also having in terms of those entry-level positions, but also how you then take your assessment of the situation for young people entry-level positions and how that feeds through in terms of what you need to do on a monetary policy response because of its impact on inflation, if any.
Well, artificial intelligence is obviously another essentially supply-side change in the economy. I think you can divide it into four parts, or at least I tend to lean on this. So the four parts are: one, obviously it can destroy jobs, in other words, remove jobs. So an example of that would be that if you create a chatbot to speak to customers, then you will reduce customer service staff. It can create jobs, new jobs. So an example of that would be data scientists. If you vastly increase the sort of capacity to analyse data, then you'll create the demand to do that by humans, because I think a lot of this is humans working with technology. The third one is where it increases productivity, and that productivity is essentially shared between sort of machines and humans, as it were. So, you know, if, for instance, it can process medical analysis a lot more quickly and a lot more of it, you can increase the demand for doctors, because then you have to do something, you know, obviously you want to act on it. There's a much weaker form of that, which I think is job negative, really, where actually it's doing it all, and all the only employment effect is the sort of the person who's sort of keeping the data center going, as it were. So that's the fourth one, which is much. So there's two rather sort of more positive ones and two, frankly, negative ones. So really it then comes down to two things. One is obviously what's the balance of those forces. Now, you know, you mentioned economic history. I won't go through this is what in economic history we tend to call a general purpose technology innovation. So, you know, you go through steam engines, electricity, internet, ICT. I do think the next one is going to be AI, and probably AI and robotics, actually, in some combination. These are the things that I think do move productivity growth, and this is really important for the economy. But for employment, the thing is, each of these has had a different effect in terms of employment. You can't generalize across these things. They're different because they're structurally different, and it's down to you know, which of those four things are the balance of those four things, but then B, the sequence of those four things, because they can come through at different sequences, because general purpose technology innovation historically has taken a long time to come through. It may come through quicker this time, because it's obviously moving very quickly, as we're seeing in another part of our world at the moment. But the classic one is, you know, it took 8 decades between sort of James Watt inventing a steam engine and it coming through in the UK productivity numbers. So, you know, they are so, because they usually require other innovations to make them actually work on site, as it were.
But is the Monetary Policy Committee now getting good enough data on the labour market? Because that was a problem that you pointed to for a long time.
I think the ONS is still obviously very much working on it. I think they have achieved quite a lot actually already. And what we have done is actually, and my colleagues were talking about this, is obviously, you know, we're great consumers of data, so we look around for, you know, we search for all the data we can get. And I would very much echo what Sarah was saying, because I'm in the same position. I think we're all in the same position, that we get very good information by going out on the road, as it were, with the agents. On this one, and I think, as Sarah was saying, you know, we are in a much lower turnover labour market at the moment. That's one of the very, very clear messages we get, that, you know, people are staying in jobs, so they're not leaving jobs, and so this affects, to your point about youth unemployment, because as Sarah was saying, you know, obviously youth unemployment is particularly affected because it's people who don't have jobs to start with who are coming into the job market, and they're going to find it more difficult.
Might I add one other thing that I found interesting watching is net desired hours, the amount that people want to work more and are unable to do. That has risen recently, the number of people want to do more hours. And I think that is an indication of slack in the labour market and the ability, therefore, of there being the reduced likelihood of there being pressure on wages. That's certainly been something I've
Dr. Dhingra, on the labour market specifically, did you want to add anything to those points?
Yes, a couple of points. So one is, I think the situation has improved, both from the fact that the LFS is now available in some form, and also from the fact that the way the labour market has turned out to be, a lot of these indicators, different indicators from different data sources, are pointing in the same direction. So that gives us a lot more confidence in thinking that what we're seeing is not an artifact of the data for that month or that, you know, quarter. It's much broader than that. And that's also taking into account what the Deputy Governor just said. I think I'll add one more point, which is, I think it's really important, the last point that you raised about youth unemployment and the effects of AI. Because it seems to be, from what the staff have shown us, they did some really good analysis showing that youth unemployment seems to be rising globally. Now, that could be a cyclical thing, which of course is very important for the conduct of monetary policy, that to what extent is that a purely cyclical phenomenon, that, you know, the people who come in last will be the ones who probably get fired the first when the economy is in a weaker position. The IFS has done some very good recent analysis on this, which is suggesting that there is a cyclical component, but that doesn't seem to be the only story, that there seem to be some more structural factors, whether that's through health issues, but more broadly, it doesn't seem to jump out that it's got to do with the minimum wage or with the NICs, because you can segregate the workers you're looking at by the age profile that gets really hit by the minimum wage or gets really hit by the NICs, for example, the 21-year-old threshold. And you can also look across different regions. Some regions, for example, South End being the famous one, where a lot more people are on the minimum wage as opposed to other regions in the country. And you don't necessarily see a strong correlation, in fact, almost none, between unemployment changes that have happened recently and the minimum wage, or to that degree even to NICs. But I think it's much more important to have that broader conversation about the extent to which AI or some of these other global phenomena are driving what's going on.
I mean, that's consistent with the view that AI is taking out more entry-level jobs. So if you take lawyers, for instance, it's taking out the sort of the entry-level jobs because they were far more sort of information processing jobs, if you like.
So I think, I'm going to push back a little bit.
Go on.
See the differences of views?
We love this about the MPC.
in the committee. You get a little taste of what happens around the table. So if you look at our agent reports, disaggregated by sector, on the effect of different components of minimum wage and so forth, they find that they're saying that there is an impact. And so
hospitality,
yes, hospitality in particular. So I think that this just sort of says more research needs to be done. But to sort of say this is a global phenomenon and the UK is just the same as everybody else, I think is something that needs a lot more consideration. On AI, I think what's interesting is that across the US, the UK, Germany, and Australia, a variety of sources. Research on each one of those elements, 90% say no impact when you ask firms. So it may be that that this manifestation is, as Deputy Governor said, which is we are not going to hire somebody if someone retires. So that's not exactly no impact, but it's not like AI is taking a job. It's just that it's allowing a replacement. And the last point I would make about AI is, we actually are using AI internally on these agent reports. Yes. We have, so they've had an extended many years across all these various regions where we have notes of, the different questions we've asked and the responses and so forth. All of that is now in a database and it is queried on questions of particular interest.
Very good.
To the committee.
Good. I'm going to move on to one last question of particular interest, if I may, Dame Meg, which is that on the 1st of July, the government is bringing in a 50% steel tariff. And I wondered if the bank has done any analysis on what the impact might be on the UK economy and on inflation from that 50% steel tariff on the 1st of July and the reduction in quotas. And if not, perhaps you could follow up with a letter.
I think we'll follow up with a letter because we've obviously looked at the whole tariff question generally over the last, more than a year now. Haven't looked at steel tariffs.
This is the UK bringing in a 50% steel tariff on imports of certain grades of steel. Thank you.
The tariffs are certainly jumping around rather a lot at the moment. Thank you very much, Dame Harriet. Chris Coughlin, briefly.
Thank you, Chair. Sarah Breeden, the very interesting discussion just now on productivity. John Van Reenen, who obviously is close to the government as his former chief economic advisor, has calculated that the impressive output numbers for the 14th of May mean that productivity increases an annualised rate of 1.6% since the government was elected versus 0.3% for the previous decade. Do you agree with that, and is that sustainable? Because it's pretty good if that is true and it's come through.
So I certainly recognise that there has been a greater focus from the businesses that we talk to on driving productivity improvements. I use the example of as people leave, they are not replacing them. There's automation happening, use of AI as we've talked about. So I can definitely see that is a theme through our conversations with businesses. Whether that equates to 1.6 and how sustainable that is, I don't know. But certainly, as the governor was saying, AI has got the potential to be the next big thing in terms of enabling businesses to do more with similar inputs.
Thank you very much. John Glenn MP.
Thank you, Dame Meg. I'd want to turn to the growth outlook of the economy. I just before I ask my question, I think one of the things is that people will have noticed is this sort of great amount of volatility in the predictions and the numbers. And for March, I think the GDP figure from the ONS was expansion of 0.3%. But I think, as has been reported, Reuters did a polling of economists, and the contraction of 0.2% was expected. And we see often restated figures all the time. So I wonder if you could be thinking about that, and how do we account for that, and how do we minimise that? But can I just basically say, look, the latest monetary policy report says that underlying growth remains pretty flat, looks meagre growth. I would just like you to answer why you think that is. Shall I start with Dr. Mann?
As I already mentioned, there are multiple ways of calculating growth, right? We can look at output growth, we can look at income growth, we can look at growth at the top line of the economy, we can look at a decomposition to look at the market sector, where we think, for example, pricing strategies might be particularly important for generating inflation. We also look at, I did a speech not too long ago looking at consumption growth, which has been remarkably flat since basically COVID. And notwithstanding increases in real income, consumption has been basically flat. And of course, consumption being an important driver of overall decisions by firms to, add workers, produce more. There's no point in doing that if the consumption looks relatively low. But I also want to, continue with my theme of not only do we need to look at growth in a disaggregated way in order to evaluate the state of the economy and appropriate monetary policy decision making, but we have a number of statistical methods where we put in high frequency data as well as sort of the normal statistical things that come from official statistical agencies, and in order to evaluate the prospects for the economy. And one of the things that has been most notable about this so-called quantum Midas statistical methodology is that rarely over the last 6 to 9 months has there been a center of the distribution of the data. I mean, if all of the data were kind of telling you the same thing, then it would kind of look like a nice hump and you'd have some tails, but it would be the middle would be like, okay, I'm pretty sure that this is going to be my growth rate. That has not been the case for basically 6 to 9 months, where our methodology, our statistical methodology, putting in lots of data is a double hump, meaning there's not a lot of mass of the data telling us the mean. It's saying, well, it could be higher, it could be lower. So it requires us to look into those two humps to get an indication of what are these data, these disaggregated, some high frequency, some is the standard statistical stuff, in order to evaluate our prospects for growth.
Right. So what do we do about that then?
What do I do about it?
Well, what do we do about that?
What do you do about that?
In terms of the country seeing these growth figures for which we generate, as politicians, great big headlines, one way or the other, but they seem to be pretty meaningless because they're often restated, and if they'd been true to what they actually were on the restatement, they wouldn't have generated anything like the headlines. And the same worked when I was in government, so I'm not making a particularly political point.
I would just offer two thoughts. One is sort of generally or specific. I'd just be therefore a bit cautious about commenting on any particular single growth number.
Yeah.
Because, as you say, they do get revised. I just go back to the first part, the second part, because going back to the first part of your question was interesting, and it does look like there's been some change in the seasonality pattern of growth. The ONS have published a really good blog actually in the last couple. James Benford has published a really good blog in the last couple of weeks, just sort of taking this on. It looks like there's been some change between the fourth quarter and the first quarter. Yeah. It may be down to the fact that there's been a shift to one fiscal event a year. The ONS have managed to sort of, I think, they think they've done the seasonal adjustment, quite a bit of it, but you obviously need to run a data to do that. So they're very much onto it, and I think that's a good thing. But as he said in the blog, actually, if you take the fourth quarter and the first quarter and put them together to get a growth figure, actually, it washes out.
Right, so you've just smoothed it. So this notion that somehow we're 0.1%
but they're on it.
higher.
I mean, that's the point, and I think that's a
being
good thing.
0.1% higher than other countries in the G7.
Well, it looks like we have a strong. It looks like we've got into a position where the growth is stronger at the beginning of the year than it is throughout the other year. And
it's been a pattern for a few years.
And he said, look, there may be a reason for that, and we are on it, as it were, in terms of diagnosing it.
Dr. Dhingra, was there anything you'd like to say on this subject?
You said, what should we do about it? So I can plug our report that we worked on for 2 years, the Economy 2030 report. There are 10 recommendations in there.
Yeah. So. When we look at the situation that we've got the lowest fiscal headroom amongst the G7, at a time when gilts are at their highest since 1998, it does sort of feel that we're in quite a vulnerable position if you look at the two key sort of drivers. I mean, when you think about the best case scenario for underlying GDP growth up to say 2030, what can we say about that and what can you say about that given the context that we find ourselves in?
Well, look, I'll say two things. Obviously, as you know, I'm very cautious about what I say about fiscal policy, so I'll only say this. I think that there is an issue for many countries in terms of sustainable fiscal policy, and it's in good part because we've got some pretty big headwinds, as you know from your time in government. I mean, running the other way. The ageing of the population is a big one. Obviously, the situation with defence is now another big one, and these are running in the opposite direction. Many governments have used fiscal policy more actively, and you can say that's because we've had much bigger shocks going on. We've had COVID, we've had Ukraine, now we've got another one. But it does raise questions about long-run sustainability, which the OBR have said a lot on. I think that's important. I do actually think that the gilt market actually reacted, I think, very positively to the budget at the end of last year because they saw it as putting fiscal policy onto a sustainable track. If it followed through to 2030, 2031, which is the outer point, it looked like a sustainable track. And I think some of the reaction we've seen subsequently post the outbreak of the conflict has obviously been the gilt market saying, well, that doesn't look so sustainable now. So that question has come up. On the second part of your question, I'll just go back to the conversation we were having earlier to the earlier question on AI, because I think, again, I'll constantly talk about economic history. But, a lot of the longer run growth is caused by the supply. It's the supply side that does it. So, technology is an important issue, and it's quite possible, I do think this is a strong argument, that we've been actually globally in a sort of a period between two of these sort of longer run sort of technology innovations. So we had the internet and ICT, contribution to growth ran out. So we've had lower potential growth now for 15 years or so, actually. It looks like AI probably will be the next one, but they do take time to come through.
Thank you. Just on that point, that's my last question, Dame Meg, is the UK in a strong, we're often told, we have got much weaker position in terms of our energy costs, but in terms of our AI, as a source of strength and momentum for the economy, how would you characterise, Governor, where we stand relative to other economies in the G7?
I think at the moment the US is the one that stands out relative to everybody else. I think the US has got a head start on this in terms of certainly the amount of investment in the US economy going on in the tech industry. It's obviously got many of the very big global tech companies are US based. So I think I would say it's not the UK standing out from the rest. It's actually, if anything, the US standing out from the rest. So the question is, of course, how quickly do we catch up?
If I might add one thing, I think it's really important as well to think about adoption separately from building the AI technology and making sure that we have the necessary foundations in place to enable UK businesses to adopt AI regardless of who the model provider is. We've been doing a lot, as you know, in financial services to try and enable the responsible adoption of that. Ensuring that happens economy-wide is, I think, the best foundation for the growth that you're talking about.
To be optimistic, do you think can you be optimistic about our relative position, notwithstanding the US's leadership?
So I can tell you that the feedback that we get from financial institutions is that our approach to supporting them adopting AI is one that is enabling them to do it well.
I think it is fair to say, though, if we look at the last round of both hardware and software for the IT, that the sluggish productivity growth in the UK has a long history. Yes, it is true that there's a broad-based productivity slowdown around the world, but UK does stand out, and it does have to do with adoption, not broad-based adoption, and it would be unfortunate if this next round of innovative capability is also somehow not fully adopted by business.
So you mean outside of financial services, which you often...
Yes.
That's where the sluggishness exists.
Yeah, I mean, I think that's an interesting, Catherine's right, an interesting area there is to look at robotics. I think the UK, on the face of it, doesn't have a particularly good story to tell on that front.
Okay, thank you, very interesting.
Thank you.
You, Anya.
Thank you very much, Chair. I'll start with my second favourite topic, which is the gilt market. Dr. Mann, you gave a speech a few days ago talking about the over the last few years, the increase in hedge fund trading in the UK gilt market. What impact does this have on volatility and also on monetary policy, in your perspective?
So the increase in hedge fund trading in sovereign obligations is not just for the UK. This is a broad-based evolution towards the importance of that group of financial institutions for sovereign debt markets. Now, the UK is particularly perhaps dramatic in terms of the change from the sort of preferred habitat long-term holders of the pension funds towards the hedge funds because of the LDI situation. So it's been particularly dramatic for the UK. Now, in terms of volatility, I think it's important to distinguish between price volatility and kind of quantity volatility. The research that was identified in the speech last week focuses on the extent to which hedge funds tend to be more elastic. In other words, their responsiveness to buying new issues or QT auctions, that their elasticity is higher than a preferred habitat type of investor. In other words, you don't need as much of a change in the rate of return on the instrument in order to make it attractive for them to hold it. So for the new issuance, in fact, it's beneficial to have hedge funds be part of the financial institutions at your auctions. That has been found to be true in Canada by research at the Bank of Canada as well. So that's the sort of good news type of story. The more challenging news is that there are many sources of volatility that change the gilt valuations. It's not just issuance. Of course, there's a lot of stock out there, a lot of factors that are going to affect the gilt price. And under those scenarios, where you have more volatility coming sort of over the transom from other places, then you end up with more elastic responses by hedge funds, which will alter the quantities that they're willing to have, and so that will create additional volatility in gilt prices. Again, this result is consistent with what the Bank of Canada has found as well.
Yes, and does this have any impact on monetary policy? And I see, sorry, maybe
in my view, it does, because in my view, volatility of the yield curve is something that I have to incorporate into my assessment of financial conditions, and against which I choose a decision about monetary policy. So volatility, to me, is a very important component of the immediate decision. It also is relevant for thinking about R star, which to me is, we do have to think about it a little bit, maybe not the big R star, but the little R star. And so volatility is an essential part of the monetary policy transmission mechanism. For mortgage rates that are going up and down with the OIS curve, I mean, yes, that's very important for the decision making of households. Do I mortgage now? Do I remortgage? Do I have to? Can I wait a little longer? So volatility is a very key ingredient to the overall state of the financial conditions.
Do you see that volatility as introducing simply more uncertainty, or is it kind of directional, if you see what I mean, in terms of rates?
I think there is some asymmetry that hedge funds are more likely to buy in on the way up and sell quicker on the way down. So there's asymmetry, but there are many, there are asymmetries everywhere. That's been one of the things that we've learned about the past 4 years, is that many responses of economic actors are not the same, depending on what the state is. These are factors that we have to incorporate, that we have learned a lot about, and we are incorporating, at least in my case, I incorporate into my decision making.
Thank you. Ms. Breeden.
And I wanted to slightly build on that and take it into our financial stability work, if you don't mind. Kind of the hedge funds are price sensitive, leveraged, and international. And that does mean that their behavior in markets will be different as a result. More volatility potentially, and higher risk premia on the back of that. So what we have been talking about in a financial stability context is trying to improve the resilience of the gilt repo market as the foundation for the resilience of the gilt market. And that's something we issued a discussion paper about last year. We're working with the Treasury and the Debt Management Office and the FCA as we do that. But I think that would be a natural counterpart to this risk premium. How can we introduce more stability and more resilience in the market?
Thank you, Chair.
Thank you.
And this takes me to my next question on everyone's favourite topic, which is quantitative tightening. And in the MPC is due to make a decision later this year about the pace and scale of that. In explaining your decision from the previous year, each of you had slightly different ideas of how quickly QT should go at pace. I'd love to hear from each panel member just very, very quickly on whether the recent changes in inflation and gilt market movements have influenced or affected your views on that at all at this point. I'll start with Dr. Dhingra. We can work down this way.
I'll just say that was probably one of the hardest decisions that I had to make in August, because we were on a loosening cycle, or rather untightening cycle. And at the same time, we were doing QT. So, of course, that you might say that that's sort of not a consistent strategy. But, of course, we have a legacy asset on our balance sheet, which came with the expectation that that was for a particular purpose and that we had to take it down. And I think that's a little bit what motivated me to vote in that direction. But at the same time, keeping in mind that actually we're using interest rate as an active tool, because we understand what the impacts of that are much more carefully than we do of what quantitative tightening does. So in that sense, there was some version, and I don't fully agree with everything that we write in the MPR. I think you can disagree with some of the precise numbers of how much tightening has been caused by the quantitative tightening we did, but broadly I think we could say that we were in a place where interest rates could have offset a substantial portion of the tightening that was coming from QT. So that was a little bit what my thinking was at the time, that it was important to get the asset purchase facility down, but at the same time to keep in mind what the tightening effects of that policy were.
And looking forward to this year with the changes in inflation expectations that you have now.
I'm still weighing what the possibilities are at the moment.
No, I think Swati set out very well there, actually, in terms of the framework. So, by the way, we haven't started this year's thinking yet, actually, so we'll get to that.
We're all thinking all the time.
well, yes, but specifically on the decision. I mean, look, what we did, obviously there are two, in a sense, that there's a decision on the total and there's a decision on the mix. And last year we skewed the mix away from longs. I think that long-dated gilts, I think that was the right thing to do. We haven't got any more long-dated gilts to sell, by the way, and this year they're all done. So we'll come back to that question because it is important. We have not, and I think this is what colleagues were saying, we are not seeing disorderly conditions in the gilt market at the moment. I think that's an important point to make. Now, the other thing I would say, and this goes to the other question, which is the cash flow question. We have done a lot of work to build and enhance the reports that we publish, because what we've tried to do is capture something which I think is very important in there, which is the UK has had a history, I mean, and a good history in this respect, of issuing longer dated debt. I think it's right that the DMO has shortened it at the moment, but even so, our debt has a longer maturity than other G7 countries. That's a good thing. And successive governments have got a lot of benefit from this, because it means you're locking in, I mean, during the QE period, you were locking in lower yields, particularly when we had a flat yield curve, for longer. Now, the government benefits from that. What QT effectively does take part of that benefit back, because we're reversing QE, and in doing so, we're taking interest rate risk off our balance sheet. As we've said before, if you don't do that, then you pay the carry cost of having the gilts on your balance sheet for longer. But what we've sought to do is to incorporate really the effect of that benefit into the calculation. And interestingly, it basically leaves the cash flow pretty neutral, actually, at the estimated end of the life of the operation.
So for me, there are two things that I have in mind when I approach our QT decisions, and as the Governor said, we've not got there yet. The first and most important thing is I do want to take the portfolio down for monetary policy purposes down to zero, because I want to make sure that we have the headroom to be able to use it again should it ever be necessary, rather than it being a forever ratchet upwards. So that is an important principle. But as we do so, we have to have an eye to the impact on the market functioning. As the Governor said, kind of the gilt market has functioned through this period, but as we just talked about with hedge funds and long-dated investors, the nature of the market is changing. And I think the changes that we made last year in terms of skewing our sales as we were taking our portfolio down to zero were our contribution to trying to best manage that.
So in terms of my sort of assessment of the appropriate strategy for QT, for me, the most important things to be considering is my instrument is bank rate. QT affects other points on the curve, and evaluating how those two things that are happening at the same time affect the financial conditions to which businesses and households are responding. So to me, that the basis of the research that is being done to evaluate those relationships is the key element. And of course, we have to kind of acknowledge that those two things, which is what we do, are in the context of a global financial market, and that the spillovers from the conduct of monetary policy, fiscal policy, and the overall macroeconomic developments, not to mention what's happening in terms of Middle East warfare and so forth, that those spillovers are extremely large.
Thank you very much, Ms. Zhang. Harriet.
Thank you, Dame Meg, because our predecessor committee in the last Parliament wrote a report on quantitative tightening, and we described it as a leap in the dark. And obviously we've now been in this leap for a few years, so we've got a little bit more information about what the real life impacts of it are. And I noticed that ING Bank published a report this week saying that they thought that the quantitative tightening that the bank has been undertaking had increased gilt yields by 0.8%, which sounds really quite substantial, given that I think the evidence you gave us at the beginning of the leap in the dark was that you didn't think it would have a material impact. It would be less than 0.25% in terms of monetary policy equivalent. And I just wondered what you thought.
I see the governor wincing.
The real world impact has been.
I'd be happy to write.
What phrase would you use then?
How much are people having to pay more on their mortgages?
When I looked at that ING report, I think that 80 basis point is actually the total change in swap spreads, and that incorporates a lot. And I think they do make this point. It incorporates a lot more than QT. But look, I might be happy to write. Maybe that's the best.
Okay, so can you update us on what impact?
Well, we'll do that if you don't mind.
That's
what you'll get when we do the annual.
Has had in the real world.
The annual review always does that, and we'll do that. We'll do that again, so you'll get that. But I'll happily write on the ING point because I think that's a bit misleading.
They're wrong.
No, I don't think they are actually.
Have a conversation about an article that we don't all have in front of us as well. So.
I think they described it in the report rather differently, and it got taken into a rather sort of different context. I think
it is difficult for us to have a discussion about an article that not all of us have read. Thank you, Dame Harriet. Just before we move on, I just wanted. We had a very brief exchange about mortgages, Dr. Mann, with you and Yuan Yang, and you talked about the volatility. One of the interesting things, of course, about the mortgage market now is that a lot of people on fixed rates will move off. So I know that the banks were looking at their 5-year fixers coming off onto obviously what would now be higher rates. So I was wondering how you factor this into your planning when you're looking at what's happening and the impact on mortgage, because that has a real run-through effect into the wider economy, less disposable income and so on.
Yes.
So I don't know, perhaps as Dr. Mann, you were the first to talk about it. Do you want to expand on that?
So there is a box in the NPR which looks explicitly at this question about how much consumers might be affected by the energy price shock as it transitions into the mortgage market. Looking at cash flow channel, which is directly the refinancing and how much you actually have to pay out on your mortgage. Now, the 5 years are in a worse place. The 2 years are actually in a better place. So, we have to take it, and we have all the information on every single one of them, so we can actually get those numbers at a very, very granular level. But there's also the relationship between housing prices and how using your house as collateral against which you might do some borrowing, and that also has implications. Now that effect is also relevant and is pointed out in the box. So I think we have a pretty good handle on this. We can argue a little bit about, I argue a little bit about this collateral channel and the extent to which it actually is being deployed and plays a role in the consumption strategy of firms, of households. That the cash flow channel is something we can't argue with because it's actually there in the numbers.
And then perhaps in answer to that, Governor, but also factoring in parts, for instance, of London, in my own constituency, one-bedroom flats are typically going at prices of 2015 prices because they're less popular for various reasons, and so that's also factoring into the mortgage market, that people had mortgages on those and then can't sell them for the rate that they bought them at.
Seen some
and not necessarily not always negative equity, but sort of not the inflationary property scenario that people have, my generation have grown up to see as the norm for many years. So I just wondered if you had any comments.
Yes, no, again, we do. We have seen some softening in house price rises, certainly. As you say, the system now runs on much bigger buffers, so it's not negative equity in the sense that we were seeing in the time of the financial crisis. But no, we do factor that in because it will be relevant to people's thinking. I was just going to add, actually, because I saw there was an article in the FT either yesterday or the day before sort of suggesting that mortgage rates have gone up in many countries have gone up more than the increase in market rates. So that set my antennae going. But actually, I think we checked, it's not the case in this country, actually, that the increase in 2- and 5-year mortgage rates is not actually larger than the increase, the rise in the market curve.
Okay, so you're not really, it's not something that's your big worry to you?
Well, I very much agree with Catherine, actually. I think Catherine said it out very well in terms of financial conditions. That's the way we look at it. But I just wanted to address that particular point because I know it was picked up in the news that I don't think it's the case in this country that we've seen mortgage rates going up out of line with market rates.
And if I might add just one point to that, Catherine made the point, but we do have really good data on this. This is probably the bit of the transmission mechanism that we have the clearest read on. As Dr. Mann said, there's a debate about whether the collateral channel is operational, whether people would buy more borrow more if house prices were higher or not. But the mortgage cash flow channel is a really clear part of our understanding of what might happen to consumption. And as we put in the MPR this time, the increase in rates that we have seen since the conflict began will reduce consumption by 0.6 percentage points. That is a chunky weight on the economy.
I'll just add one thing to that, which is we did have a long discussion about this, since we need to be prepared for every eventuality, which is to what extent is the mortgage channel going to be different this time compared to, say, 2022. And there's been absolutely really granular detailed data which can also be linked up to consumption patterns to some degree through credit card, for example, transactions. And we can see pretty clearly that the consumption channel was working in terms of the monetary transmission mechanism through this mortgage cash flow channel, as well as that it looks pretty similar now, even though there's been quite a shake-up in terms of who's on fixed, who's on variable, who's on 2 years, 5 years, but it looks like roughly we've settled at the same kind of place.
Thank you very much, Jonathan.
Just for clarity, I think the MPR report in February points out that for new mortgages, the increase in rates has been on average 100 basis points. Is that in line with your expectations, or did you expect there to be? Because I mean, there was a lot of speculation that was sort of priced in about what your decisions would be. Does that increase reflect what you would have expected?
So you're talking about the increase sort of since the conflict broke out, yeah.
If I might add,
in new mortgage rates, I mean the 100
basis points. It's a bit less, but around that, yeah.
Let me have a go at answering that, and you can tell me whether I have or not. What we've seen since the conflict is that, for example, 2-year mortgage rates have gone up by about 90 basis points, 5-year by about 70 basis points. That is consistent with the underlying moves in market interest rates rather than the rates charged by banks having widened. That is worth 60 basis points on consumption, but it comes on top of a monetary policy stance that was already weighing on consumption to the tune of 80 basis points. So to where we started this discussion about how much do we need to further tighten monetary policy as opposed to be able to hold where we are. I think those two numbers of 80 basis points of impact on consumption in February, a further 60 basis points since, that gives you a sense of how much monetary policy is already weighing on economic activity and so offsetting second round.
I just want to add, there was a point after the March decision when I felt that the market had gone too far in terms of its reaction to that. Now, there may be a number of reasons for that. We had to take cuts off the table. That was quite an abrupt thing to do, but this was an abrupt event. There may be a bit, going back to Catherine's points about, there was a lot of hedge fund positioning for us to cut, not unreasonably. That seemed like a reasonable sort of, assumption to make. That hedge fund positioning came off, though, quite abruptly. Again, that did cause the market to move. And so there was a point when the market was pricing us to raise rates 4 or 5 times this year. And frankly, I've got a high bar for going in and saying this. And I thought, look, I think I said, use the words, you're getting ahead of yourselves here.
Thank you. John Grady, MP.
Thank you very much, Dame Meg. Deputy Governor, you've mentioned, I believe, that you're a professional catastrophizer. You should try being a Labour MP with 2 teenage children. And you've also said, the thing that keeps me awake at night is the likelihood of a number of risks crystallising at the same time: major macroeconomic shock, confidence in private credit, AI and other risky valuations on stock markets and so on. So on a scale of 1 to 10, 1's very relaxed, 10's extremely worried, where would you put yourself on risks to financial stability at the minute?
So I think we have described them as a committee as material and elevated. So we're at the top end of the distribution. The things that you picked up on in your comment just then, the fact that risky asset prices appear not to reflect the risks in the economy that we've spent the last session talking about, the fact that private credit is a new form of credit that is important to the real economy, that's got leverage, it's opaque, it's got complex interconnections. We don't have good visibility of that at the moment. Those things do keep me awake at night. I think what gives me some reassurance is that the core of the banking system is resilient. We've been here with our Financial Policy Committee hats on and talked to you how we've stress tested the banks, and so that core of the system is in good shape. So I don't know, maybe I'd give it a 7, 8 out of 10 on that basis.
I mean, if you don't mind, I'll put my other hat on and because I chair the Global Financial Stability Board as well for my pains, so I don't have enough to do. I mean, Sarah said there are 5 things that really we're sort of focused on. One is asset valuations, and particularly the sort of the AI implications of that and sustainability. Second one, private credit, which Sarah's just referred to, which, by the way, of course, is particularly in the US, is financing a lot of the investment. Third one, which we've talked about a lot, is hedge fund leverage, particularly in core government bond markets. The fourth one is the introduction of new forms of money, particularly things like segways. And the fifth one is the one that is the other big thing that's happening at the moment, which is this whole thing around MIFOS and the whole question of the increase in potential cyber risk as a result of the power of these models.
And I think, Deputy Governor, you mentioned that one of the reasons to sell down the bank's holdings of gilts is to give more headroom to deal with financial instability in the future. Another tool in the locker obviously is interest rates, but we have a less benign inflation environment. And then at the same time, government finances are stretched. Debt to GDP is about 100%. And we're not the only, if you like, G7 economy in the States. I mean, Japan's got over 200%, the US is over 100%. So we're in a very different environment to the one we were in 2007, 2008. How confident are you substantively that we have the headroom to deal with a financial shock, given we're at 7 or 8 on the scale?
So I look first of all at the core financial institutions that matter for the provision of credit to businesses and households, the banks. I think we're in a good position on those. The other really important thing is the resilience of the gilt market. I mentioned in our discussions earlier, the participants in that market have changed. There's a need to build further resilience in the gilt repo market to underpin that. We are pushing ahead with that. So we have a plan of work that will enable us to be in a better position. And we have use of our balance sheet if necessary. We've introduced, for example, our contingent non-bank term repo facility, which is there to step in the event of gilt market dysfunction if we need to do so. And we continue with our financial stability hats on to explore all the other risks that the Governor just highlighted, with a particular focus on private credit at the moment, and we're doing an exploratory exercise on that, and we'll be able to tell you more about that at the half year.
Now, there's a lot of work to look at this, and one of the themes we've had from previous discussions, I think, Governor, is the need to understand much more about private credit, which probably requires international solutions. Are we ahead of the curve on this, if you like, or do you feel, Deputy Governor, that we've got some catching up to do, and actually we all need to roll our sleeves up nationally and with the Treasury and internationally as well to look afresh at financial stability?
There's a danger I'm marking our own homework here, so please take this comment with that in mind. I think the Financial Policy Committee is doing a good job of picking up a rock and looking underneath it at areas where the new risks are occurring. So we did an exploratory exercise that looked at how the behaviour of the gilt market is different. Now we have different participants in it, and we've got a plan of work on the back of it to improve the resilience there. We're doing work on private credit to try and better understand that. We've got work in train on Mythos, on stablecoins. So I do think that we have got good actions in place in order to fix the areas of vulnerability that we are concerned about. The other thing that's very important, though, is that we talk about these things publicly, because our first line of defence here is the financial institutions in the market, and that's a big part of why we put these issues out there in the public domain.
Are you content with the reactions of the financial institutions? Do you feel they're de-risking sufficiently, or taking steps that you'd wish them to take?
I think that the fact that the banks pass our stress test gives us some grounds for reassurance, but there is always a need for banks to continue to double-click on these areas of interest.
I think there are two big questions, I think, in that world. One, and this is what the systemic exercise is addressing, is does everybody properly understand the interconnections between private credit and other parts of the system? Because they are interconnected. I mean, the interconnections have changed in a way. I think, by the way, I think private credit is a very important part of the infrastructure of the sort of whole system, because it's funding a lot of this investment in tech. So the interconnections are important. And then the second one is, do the people who own it understand the sort of the characteristic of the thing they own? Because if they do, then the reactions will be easier and smoother. If they don't, then they'll be more abrupt. Yeah.
And just final question from me. We've mentioned Claude Mythos and developments in AI. Let's say I was out in the Calton in my constituency on Saturday, and someone said, what's all this AI and Claude Mythos? What's the risk to me? I mean, are you seeing a risk to things like payment systems and things like that? Some sort of shock like that, something that could affect people, going to withdraw cash to go to Morrison's in Calton on a Saturday morning?
So it's Claude, Mythos, and the other models like it, it's not the only one, is a big deal in terms of increasing the capability to identify and exploit cyber vulnerabilities that exist in technology already. Our understanding of it at the moment is that if you are a well-defended institution, you should be in a good place, because you'll be able to see the model coming and be able to ensure that it doesn't get in, doesn't exploit those vulnerabilities. So for the core of the system, the biggest banks, the biggest payment systems, they should be well placed to defend themselves against such an attack. But be assured that we're working with them to make sure that they are so. And also, what we have to be ready for is the wave of patching that is going to come their way as all of these vulnerabilities have been identified and require software to be updated to ensure that they are more resilient in the future.
Governor, come back and then come back.
I just want to add one. This, of course, is not limited to our world. Let's be very clear. This goes across the whole landscape. I mean, our world is obviously an important part of the world, but this is about the IT systems in all parts of the landscape.
It matters for energy, for health, for air traffic control.
And should be means they're probably, and the fact that you're working with them would suggest to me that the Bank of England is not entirely content yet that people are, because there is a difference between should be and are, isn't there, Deputy Governor?
So it's
sorry to nitpick.
No. It's a reasonable point to make. We have been working for many years with banks to get the basics of cyber hygiene right. What you saw with JLR, what you saw with Marks and Spencer's and the Co-op, is that this is a difficult thing to do across the entirety of your waterfront. It's much harder to defend against everything as opposed to finding the single weak point to get in. And that is what we are working with firms to make sure they are ready for.
Thank you very much, Deputy Governor.
Thank you very much indeed. Well, can I thank our witnesses very much indeed for their time. We had a very interesting discussion discussing, of course, the latest interest rate decision back in April, and particularly the impact of the war in the Middle East on UK energy and food prices. We also covered the MPC's outlook for unemployment and wage growth, and concluding concerns around the labour market data, a perennial issue here, and for the bank, and the impact of AI. And we also covered the MPC's analysis of recent economic growth and the pace of quantitative tightening and the mortgage market. Can I thank our witnesses very much indeed? That's Dr. Mann and Dr. Swati Dhingra, both independent members of the MPC, the Governor, Andrew Bailey, and the Deputy Governor, Sarah Breeden. Order, order.